Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter. We're going to talk about commodities, wealth building, and or financial topics. I think they asked me a question about a 2024 uranium projection. I'll talk about it. I don't really make too much projections, but I'll give you my opinion and why I'm bullish on uranium and all the other commodities. I'm bullish on basically everything. Could we get a pullback? Could there be a slowdown? Could there be a recession? Yes, there could be, but I'm looking at this from a longer time frame. I'm going to be bullish, even if we get a short-term pullback, even if oil goes to 60-something dollars a barrel. I'm still going to be bullish, thinking that it's going to go up in the longer term. So let's dive in here, and I'll give you my financial opinions. If you want to follow me, it's at Finance. And if you want to join our community, it's finding-value.com. We have discount as a coupon code if you'd like to get a little bit of a discount. And here we go. So Slingshot is asking, hey, any chance you could punch out a 2024 uranium forecast? I'm not very good at forecasting. I will say that. I'm good at finding entry points where the value is. But let's do what I look at, all right? So I've got URNN sitting up here. URNM is the Sprott Miners ETF. It's kind of the pure play for all of the mining companies. It does hold some physical, the SPUT in there as well, I think. And when I look at this chart, I think it looks fantastic. What I see is a big move up, a consolidation, a squeeze, there's your dead period, and then we started moving on up. We had a little consolidation here, and we're starting to break out of that consolidation to the upside. So what I would say is this looks incredibly bullish for uranium. Here's your closing, and that's just breaking to the upside right now. It's also got, it tried selling off, but we had buying pressure there. I think it's game on, boys. I think it's game on. So a forecast going forward, I think we're going higher, much higher. How much higher? I don't know what the move is going to look like and when the pullbacks will occur. I'm not going to claim that I know, like I'm some sort of fortune teller knowing exactly where uranium's going to go. But looking at the chart of URNM, I'm going to say it's going higher. We go URNM versus UX1. Not a lot of data here, but I look at this, guys, and I think we're going way higher. That's me. Now, I don't want to get overly bullish, but this is URNM divided by the futures pricing of uranium. And what I see here is the pattern I look for. I usually get you get this two kind of hump, you get a move up, you get a consolidation. We've got this big long dead period. We've broken out of the downtrend and we're just sitting there. Now, if I zoom in on the right-hand side, this looks bullish. We've got kind of a bigger green candlestick, not much selling pressure. And I think what's going to occur here is you're going to start to see an outperformance of URNM versus uranium, the underlying futures pricing. So when I look at this chart, I think the first thing that pops in my head is I should buy a bunch more. And it looks fantastic for an outperformance of URNM. We can also use URA divided by UX1. We've got more data here. And I look at this chart, and I'm like, man, this thing is cheap. Look at this move here. In 2016, you can buy the URA ETF for the same exact valuation against the future price of uranium. And obviously, this is cheaper back here because in both of these instances, uranium has gone up, as you go forward. But looking here, this looks fantastic for a move higher. So I think, I don't want to put myself in and put myself into a corner and say that it has to go higher, but this sure looks really, 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 really good. I would be a massive buyer here in this corner here for this ratio chart, looking for URA outperformance of the futures pricing. I don't think any of this has been priced in my opinion. Then you can look at something like Camco. Camco's our leader. And to me, it looks like we're breaking out of all of these resistance type levels. This is your accumulation cylinder. This kind of looks like that accumulation cylinder. I've put up multiple things over this in terms of what it looks like in terms of fractals. We've busted through this resistance area in here. There's a lot of resistance right there. And we could get a retest. I mean, you know, we could pull back. It is possible. I'm not calling for it though, because this still looks very strong to continue higher, not lower. So if there is a pullback, no big deal. You know, I'm not the genie in the bottle. If you rub me the right way, you're not going to get an accurate prediction. All right. So I think CCJ looks good. We can look at something like a mega uranium. Use this as kind of a gauge because we've got data on it. Last bull market, if we kind of look at what last bull market did, let me go to the weeklies here real quick, guys. So here's last bull market. We had a basing period, and that basing period occurred from 2003 and really didn't break out of that base till 2005 of February. So we were in a commodity bull market. We had lots of money coming into the system. And a smaller guy like Mega Uranium didn't really move anywhere till February of 2005. Had a massive move. Big, gigantic move. How big is that move? Well, it went down in the month 40 cents all the way to 75 cents. It went up almost 100% in a week. A week. Then we had a consolidation sideways here. Almost like a double bottom, and then we broke out of that and just ripped. So we can back out. I can kind of pull forward here. And I think that we haven't even had this big rip yet. We've got nothing that looks like this. Nothing that looks like that. Not even Camco has really broken out and started to rip like this. Will this come in the future? I don't know. I don't know if the juniors are going to rip it from, 40 cents to $5 in a year and, a year and 3 months or something like that. Maybe in about a year. This is just over a year. So it did a 20 bagger in like a year. And then I think it kept going after that a little bit too. Yeah, it kept going. It'd be very hard to time this top, this ultimate top. But it just ripped it, had a massive pullback, and then ripped it again. So that's Mega Uranium. It did it over about, I'm going to say, a little over a 2-year time frame. Mega Uranium went up 40 cents all the way to almost $9. Call that an 18 to 20 bagger in about a 2-year time frame. Have we seen that type of move in any of the junior companies? No, not even close, guys. I don't think that this type of move has occurred yet. I do think it will occur. I don't know how big it will be, but it hasn't occurred yet. Will it occur in 2024? Well, let's take a look at the most recent trading data here. We went into a big bear market. We went into what I consider to be the double, a big basing pattern. That's what this basing pattern is. And I think what I see is an accumulation cylinder that is occurring on the right-hand side here. Kind of a 1, 2, 3. You can put it over here too, like a 1, 2, 3, 4, 5, 6, 7. And now we are ripping to the upside. We've gone from 16 cents to 42 cents in, what is that? That's July to where we are today. So 4 or 5 months. And I think that this has a possibility of continuing to rip because we just broke out of the basing pattern for Mega Uranium, which is a small junior company. and we're starting to clear a lot of resistance. There's a lot of resistance in this move, and we still have resistance ahead of us, but a little bit of resistance here right at about 80 cents. We have to double to get to that, about 60 cents to 80 cents is there's going to be resistance as we go up. So right now it's ripping, and it kind of looks like an accumulation cylinder, and that looks pretty good. I'm just using Mega as an example just because it's got some history behind it. So I think we have a long way to go, guys. I think we have a long way to go. And the juniors really haven't even taken off much. And we can see that in the equity to futures pricing ratios that I was showing earlier. So for 2024, guys, I think we go higher. We didn't see huge pullbacks in 2005 or anything. So I think what's going to occur, I mean, we could consolidate for a little bit maybe, where we kind of bust out and we consolidate at a certain point. So maybe this goes up to like up here and consolidates for a little bit, creates some sort of pattern and then rips it again. Again, I don't know the future, but this looks really good. And I would say 2024, I would be entering the year of uranium with a positive mindset is what I'll say. So coming on down, Charlie Balillo says ISM manufacturing PMI has been below 50 in contraction for 13 straight months, the longest down streak since 2008 and 9. So maybe we're in a slowdown. Obviously, the manufacturing PMI is telling us we're in a slowdown and that we're actually shrinking in terms of manufacturing. So that is something to think about. If we have inflation, if uranium's going up as fast as it is, and imagine if this all turns around and we get even more inflation in the system, I think it's going to add to the tailwinds that uranium, oil, and all these other ones already have. The only reason that some of these things have been held low is because the economy is slowing down. It's been in contraction. So, but here's another thing too. I don't know what's causing that necessary contraction either. It could be that we don't have a lot of people to fill job openings. There's a lot of job openings, and the Generation Z is a smaller demographic. So here's the Fed went way too far. He goes, probably nothing. A rapid decline in bank lending. So we're starting to see bank lending decline a little bit here. You can see it's going a little bit below zero. That very rarely occurs. Bank lending could be contracting due to the losses that they have on their books. It could be due to mortgage rates being at an unaffordable level. It could be a whole bunch of different things here. But this will or could manifest itself with a slowdown in the market at some point. The slowdown in bank lending, generally there's a lag of about 12 to 24 months when bank lending comes in the system and when it slows down in the system later on, like when it hits the consumer price index. It's about 12 to 24 months, so we could see a slowdown. And that's where I keep saying we could see a slowdown still ahead of us because bank lending it's basically contracting at this point. House priced in gold is not expensive. They can get less expensive if the thick black line falls lower. So there it is. Could we break down on this in terms of the median sale price of houses sold in the U.S. priced in gold? So home prices are not expensive in relationship to gold. And I know a lot of people look at the median income. They look at all these different measurements. But when you price it in terms of gold, housing is still cheap. The 1971 peak was about 690 ounces of gold could buy a house. The 2001 peak was around 690. And then we could see maybe this goes up, maybe it breaks lower. I don't really know. Again, I'm not the genie in the bottle. I'm not Christina Aguilera. But we're on support, and we'll see where this goes over time. but it's not expensive in relationship to some assets, the actual pricing of homes. So you sold the uranium on the run-up. It says how to buy back in lower. He's reading the book, and it says you can't. Someone was asking me in the message section on Twitter, how do I handle volatility? Should you take profits on the way? He gave an example of a specific company. And all I'm going to say is, generally when I hold and I find a valuation gap in the market, that valuation gap is when you compare the ratios and you get a really good price in a stock when the ratio is very low and the ratio continues to be low. I have found that it's easier to accumulate the dips and hold the rips until it becomes more expensive. It is very difficult from a psychological standpoint to buy back into a company when it is 50, 60, 70, 80, 90% higher. I just can't psychologically do it. So my approach has always been get a good entry point, buy it. Buy as much as you can if it's a really good entry point. If the technicals say it's good, the ratios are good, and the market conditions are shifting in favor of that commodity or sector, then I accumulate and buy on dips. That's all I do. Now, there could be things where the dips are 50, 60, 70% corrections. And someone would say, I'd be better off selling it and then buying it back. The problem is you don't know the future. You don't know that that dip would be that big. You don't know that you're going to have the psychological, how can I say it? Buying back in when the stock goes up is incredibly difficult. So I don't put myself in that situation. If we are still at a very good valuation and I see no reason to sell it, why would I sell it? What else am I going to buy? Oh, look, I booked a paper gain. So what? Now you got to pay taxes. And now you have to have the stock go below whatever that tax amount is. So if you're paying, I don't know, if it's a short-term hold, and that's probably going to get taxed at 20 or 30% or something like that. Now you have to have the stock go down greater than 20 or 30% for it to be worthwhile to buy back in. And now you're trying to time the market, and it's like, guys, that's just too hard. And I don't do it unless you're trying to do tax loss harvesting. I'm not going to do it, guys. It's too rough, too stressful to do it. So I don't do it. And then you don't get in this situation. I bought a bunch at 2020 and I'm still holding. Some of them are up substantially and they're starting to move again. And it's like, holy crap, this is really good. And I didn't sell it and try to time it. And I bought a whole bunch more when it pulled back. So I'm looking good. I'm feeling good. And hopefully uranium just keeps ripping. That's what I'll say there. Mike says, now that we're post-Thanksgiving, we can start to look into the 2024 housing market. And for the most part, things look kind of promising. Promising. It says, I have the latest real estate market details and some of the 2024 signals in this week's Altio. So we've got total inventory for sale is still incredibly low. It's not high by any means. So tight inventory. This is your year-over-year inventory change. So we have gotten some increased inventory in the red areas. Kind of a slight increase with these other areas that are not as dark. We've got percent of properties with recent price reductions. We can see 2023 is a little bit below 2022, and it's about 38.7%. So people are pricing their homes a little bit higher than what the market may be giving them, about 40% of them. Median home list price, you can see that we are still higher in terms of median home list price on a year-over-year basis. So we're still continuing higher on a price perspective than the year before. And that's the median list of new listings and the median home price. So you can see there's a little bit of disconnect between the median home price and the median price of new listings. Coming on down, we've got credit card spending has collapsed and has officially entered contraction territory. And this is where, there is a slowdown occurring, in my opinion. It also makes me think that we are earlier in the cycle than what most people think. I know people think we're entering 03, 04. I think we're entering more like before that. Maybe it's like 2001. Like we're still in a pullback or a potential slowdown in the real economy. And it's just all being papered over and hidden from a nominal perspective. But credit card spending, it's above pre-pandemic levels, but it is declining. The most frequent question during my meetings with investors is who's going to buy the massive issuance of treasuries, often followed by how much debt is simply too much, and what might a full-blown crisis in the U.S. Treasury market look like. So the U.S. debt to GDP ratio nears 100% and is set to rise further. And there's the federal deficits. You can see the massive deficits in 21 and 20. 22 and 23 are still high, but these deficits could balloon with where interest rates are at. And I think that's where the interest payments could get pretty nasty. So how much is too much? I don't know, but I think we're getting close to that point where we've got too much. Or we've already passed it recently. Oil sees very volatile moves around recessions. In a recession, oil collapses. After a recession equals oil spikes. So we can see in some of these recessions, oil pulls back. Maybe we'll get a slowdown and maybe we get a pullback in oil. And we could pull back even below this recent support where we come back down before rocketing higher. That is a possibility. We could have an A, B, C correction, and we haven't gotten that C leg of the correction yet. So this would be kind of like an A, B, C correction. This one's kind of a bigger correction here. And then we've got kind of a massive correction there. That's a big boy correction. And then we had another massive blowout in 2020. But we'll see. Again, we'll see. I'm hedging myself with time. Take my positions, stick with it, and ride it. Dustin says, oh, this is cold. It says, days after launch, you sit at a red light. The novelty is gone. You aren't any happier. Maybe it's your imagination, but the gaps in the doors look off. You think you saw a car full of teens laughing at you earlier. You're now $100K in debt for a meme, and you feel nothing. And I'll be honest, guys, like, I don't, just cars in general, brand new cars, I'm not going to buy anything that costs $100,000. That's ridiculous. And half these people can't even afford it. They just make the monthly payments. They have no assets, no investments. And that's just, I don't know. I couldn't live like that. That's all I'll say. I just can't psychologically live like that. And this is true for any new car. That's any new car. The construction boom in the U.S. is an important driver holding up the expansion. In typical recession periods, construction spending slows, particularly residential. As rates tighten, which then creates broader knock-on effects, no significant slowdown today in terms of total construction spending. Now that's something that goes counter to a lot of the data that we're seeing in terms of credit card spending declining and all these other things that I'm showing you. This is in stark contrast to what everyone else is saying. And this is generally the leading indicator. You can see that it turned over in 05, 06, and then it was starting to go down. We got a recession. The 2001 recession, it powered on through it. So that is what I mean by there's conflicting data, and I'm just going to ride through it. We've got strong total construction spending, but we could get a small recession like we did in 2001. It's very possible. I don't think it's going to be a big blowout, great financial crisis type move, unless we see a hyper supply phase in real estate and this starts to roll over. Cape December indicated $40,000. And I don't know if this is reversed yet, but the Cape in dry bulk shipping, the Cape size uh, dry bulk shippers are just ripping to the upside. Now, again, when you get a move that looks like this, it'll reverse and come back down at some point. But I know the Panama Canal, I think, is having some issues, and rates are spiking at this current time. Rick Rule says precious metals bull markets first tend to favor gold as fear buyers rush toward it for insurance. Once gold has gained momentum and the precious metals narrative has achieved wider acceptance, investors and speculators enter the market and silver begins to take over. So we're waiting for gold to really start to take off here. I know we had a pretty big selling pressure day, which is okay. Just got to be patient. And silver will have its time in the sun after. Just be patient, guys. It's coming. And then Cuppy's got it's happening. That's with gold breaking out, but it reversed lower. Look at this guy, Gold Bugs today. And it's got funny music. If you're buying gold, you're racist, says Janet Yellen as a joke. Gold longs to central bankers. We smashed through 2100. This is Africa. Basically alluding to our interest expense payments and how much they've been ballooning. They're just printing money, printing money, printing money. Here's another one. China's control over rare earth market is nearly absolute, handling most mining, refining, and manufacturing processes. This dominance poses a strategic challenge, especially to the U.S. depends entirely on imports for refined rare earth products. It says their scarcity and unique properties make them a gold mine for investors. Keep on future forward industries. This chart shows global rare earth elements production by country. As you can see, China's the 800-pound gorilla. So let's take a look. China produces 70% of global rare earth production. United States is 14%. And then it goes way down into single digits with Australia, Myanmar, Thailand, and other nations. So China's got the stranglehold on rare earth production. And a lot of people think that we're going to adopt all of these renewables, but China's the one that has basically what we need to adopt all those renewables. It's a key component. Well, we got a lot of squiggly lines here, but for people not close to freight, the U.S. consumer, or the inventory cycle, I'd just like to inform you that we are so back. It says one of the great things about freight data is how broad and fragmented the market is, along with the fact that supply chains are upstream. Our trucking and container data sets come from completely independent sources. It suggests that something macro is happening. That is what I'm seeing in container and trucking. Year-over-year volume comps in both data sets, both inflected in recent months, suggesting that inventories have burned off and the goods economy recovery may be on the way. So even though we've got all this kind of lagging indicators that look bad, screaming a slowdown, trucking and freight is going up in terms of volume. So maybe that's an inflection point where things are turning positive and one of the leading indicators. It says, when investing, you should never go full retard. Cuppy, hold my beer. We're going to buy monkey JPEGs for our clients. And I just think that's ridiculous. This monkey JPEG crap and the NFTs. We've got net speculative oil positioning is near COVID lows, and that's generally pretty good to become bullish. As these net speculative positions are negative, that's generally a good spot when you want to go long in each of these general areas. Paper shorts, study to understand silver's explosive, platinum and gold as well. This is the concentration of traders in the CFTC COT. So this is the largest trader short versus days of production. Silver and platinum are the two most shorted metals on the market. Gold being third. And these, when they reverse, could rapidly move in the opposite direction as shorts have to cover their shorts if they want to prevent losses. So silver and platinum are the two that are the most explosive to the upside if they were to get into a situation where the shorts have to cover. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up, subscribe to the channel, subscribe to the website if you guys like. But most everything, we're getting split data on the macro. We're seeing some negative data like manufacturing PMI, credit card spending, bank lending. All those look like a potential slowdown. But then we see positives too, like home prices don't look that bad. They're still continuing to track higher. There's freight and some other things that look good. So it's kind of a mixed bag. And in all honesty, guys, I don't know which way it's going to move here in the short term. The data is completely mixed. We see construction spending continuing to move higher. That's generally a positive sign and does not indicate a recession. So flip a coin, guys. Flip a coin. That's my best guess in the short term here. But that's what I've got, and we'll catch you guys later. This is Finding Value.